I'm Daniel Levine, and this is the Bio Report.
The growing convergence of information technology and biotechnology are creating a compelling new group of companies that live in both these worlds at once. Lux Capital, which has long invested in both sectors, has a growing portfolio of these emerging TechBio companies. We spoke to Adam Goulburn, partner at Lux Capital, about his investment process, how he tempers the promise of technology with management realities and market timelines, and the changing landscape for venture investing. Adam, thanks for joining us.
Thanks for having me. Excited to be here.
We're going to talk about the convergence of the life sciences with information technology, Lux Capital, and your own approach to investing. Not to disparage your peers, but it doesn't take a neuroscientist to be a venture capitalist. But you, however, are a neuroscientist. How did you become a venture capitalist?
Well, I'll ignore the first part on it doesn't take a neuroscientist to be a venture capitalist, which is true, by the way. I was always fascinated with science, and in particular the interface between science, innovation, technology, and business. So my background, I actually did a business degree. Well, in Australia, I did a business degree and a science degree. I really loved the technology piece and the life science piece. So I ended up getting a little bit more of a technical degree with a PhD and then a postdoc from Cornell over here. So I went down that route in terms of the path towards investing in early stage venture and creation, but that's not the only way you need to go. So, but I was always kind of it's always what I wanted to do.
You're a partner at Lux Capital. For listeners who may not be familiar with Lux, where does it sit in terms of the venture capital landscape? What's its world of investments? What types of companies does it invest in? And what size investments does it make, and at what stages?
Right. Lots of questions there to unpack. So, look, Lux Capital is a generalist firm and fund. Some people might say we're a deep tech fund or a frontier fund. I like to think of us investing in people, technologies, and companies that are inventing the future. So turning science fiction into science fact. One of the things I say to entrepreneurs when we're having conversations, I like to say, we invest in no ideas too early and no ideas too crazy. And so that means we're investing across a whole host of different technology companies, from drones to satellites to 3D printing to surgical robotics and, yes, biotech. We cut our teeth in early stage investing. So first, think of it as first rounds of funding, and that can be as early as two people in a room and an idea on the back of a napkin. We certainly have done company creation, and I've started 3 companies myself in the biotech space. But first or second institutional round of funding is where we tend to invest. Although most recently, we raised 2 funds, which the second fund that enables us to invest in later stage rounds where we want to continue to double down across our winning investments.
Biotech has long been the domain of specialized funds. I'm wondering, from a cultural point of view, what's it like inside a firm that invests in both tech and biotech, given that they move along such different timelines? How does that temper investment decisions within Lux, and does it make this emerging area that's being called tech bio an easier thing to do within a firm like that?
Well, yeah, I mean, look, there's always some of that tension there on kind of timelines or time horizons of investments. I'll say there's a large amount of that initial question is true, and then some part of that is being challenged right now. Across the investments that we make, quite a few of them need to be capitalized well. They're long-term time horizons. They're maturation of technology that are transformational, not incremental. And so I think the differentiator with the biotech or the life science portfolio is just where are the value inflection points? They're not revenue generating, although we do seek a long-term time horizon with our investments, and so we want to stay very long with our companies, be it biotech or robotics or self-driving cars. So it's really about thinking about the value inflection points on the biotech side, and how do we get future funding? How do we build those teams and technologies out in order to set the company up for success? I think the last thing I'll say to that question is, what works for us in biotech and life sciences is the sector that we tend to seek out, and that is large platform investments. So not focused on a single asset or a single disease sector. And those platforms are often, if not all the time, cross-pollinated with multiple technologies, be it automation, robotics, AI, machine learning. And so that means the remainder of our portfolio that's non-biotech, which is probably 65-70%, isn't sitting off on an island, or the biotech portfolio isn't sitting off on an island. We're tapping into that expertise of all those other companies that can funnel into our biotech investments.
I imagine whether it's a technology company or a biotech company or something in between, that there's something that constitutes a Lux investment. There's a commonality to that. What is a company that Lux would invest in? What are the qualities it looks for?
Yeah, well, team and people is the one thing that stands across whatever sector we're investing in, whether it's early stage or late stage investing. You're looking for incredible founders, entrepreneurs, operators, and people that can scale a business and grow a business. I think when you think about the life sciences, we're looking for the transformative rather than the incremental. I gave a little bit of a insight into it before. We won't specifically look for a single asset that's in dermatology or a single asset that's in ophthalmology. We look for companies like Recursion, which is doing phenotypic cell screening using computer vision. Icon, Recursion is now a public company. Icon, which is using cutting edge microscopes to look at protein interactions. And so these technologies and platforms can be applied to multiple multiple disease areas. So I think for us, we think about the size of the market, how transformative the technology is, and certainly the teams that we're partnered with and investing behind.
So what are some of the transformative technologies that are out there that are exciting you and attracting you to invest?
Yeah, look, I'll use the buzzword that most people seem to be using today, but it holds true for biotech. AI and ML, so artificial intelligence and machine learning, are really at the earliest stages of showing their value towards biotech and drug discovery. I think we're entering a new world of what is scaled biology, or the industrialization of biology, where the existing foundations that we built will go hand in hand with computers and machines that will enable us to do a lot more and be a lot more targeted in what we do, and a lot more efficient. So that's one area. I think specifically looking at imaging within biology and life sciences and drug discovery, and that lends itself to computer vision. Imaging has disrupted every other industry that we've looked at, be it satellites that can count the number of cars in car parks at shopping centers for fintech opportunities, or Wall Street for people doing investing, or computer vision for self-driving cars that can see the outside world. I think all of that technology is now coming to biology, and we're starting to peer and look into cells and life like we've never been able to see before. It's usually been, snapshots in time on fixed or frozen cells. Now we're looking at life in its real form. And then a couple of others like CRISPR. I think it may be an old legacy sort of technology to some, but we're only just scratching the surface of what that technology can do from being a molecular toolkit for scientists in the lab, and then single cell sequencing in a similar vein. It's been around for a number of years now, but I think it's redefining how we classify cell types, which is who we are, which means redefining how we think about targets as for drugs. And then there's a second layer of technologies that are coming on top of single cell sequencing, like spatial transcriptomics. Where are these expression levels happening within a cell, and so on and so forth. So they're just a couple of areas that we're diving into at Lux.
Well, how do you distinguish between compelling science and something that really warrants having a company built around it?
This for me, I think if you asked 100 biotech investors, you'd probably get a wide range of answers. This for me is a little bit more art than science, and I think at Lux we're probably given a little bit more leeway, given that we are investing at the cutting edge and we are investing at the earliest stages, right? So we do thesis development here, where we explore and probe certain areas and new technologies, and our investors in our fund have given us, we're fortunate they've given us the ability to go invest in these areas. In fact, they expect us to. So I think we invest in transformative science, not big science. We're not investing in research projects, and some of that is just patent recognition. I think people matter, so we're backing academic scientists that have built companies from scratch before, and know when the time is right for their technology to be commercialized, and so it's an ongoing conversation. And look, sometimes we have to choose in order to believe that a certain area is going to be a lot more meaningful and valuable, 3, 4, 5 years down the line. And one company that we started is a company here in New York called Calliope. That was a company that was focused on the gut-brain axis. We started that company 5, 6 years ago when the gut-brain axis was just emerging, and right now it's a very hot area in terms of a new modality and a new paradigm to target various diseases through your gut. We needed to make that bet 5 years in advance in order to build the barrier and a moat that we have on the technology and the platform side. So some of it is a little bit of a, I know we're talking science here, but some of it is a little bit of a leap of faith.
If I'm correct, you are the founding CEO of the company.
Yeah, and that's something we do here at Lux. As founding CEO, my job is to find, the person to back. That's my number one priority, in that role. And so Nancy Thornberry, who is the CEO that we brought in, is truly exceptional. Spent 25 years at Merck and built their most successful drug of all time, and she wanted to jump in, head first and build the company from scratch. So, I hired the first 10 people, including Nancy, rolled up, my sleeves in order to kind of build a little bit of that infrastructure. But it was certainly Nancy that took it from there to build it to a 100-person team that it is today, and raise, in excess of $200 million.
Using that as an example, let's go a little deeper. Walk me through the thought process as a venture capitalist. When did you see the opportunity? What were the issues as you thought it through as a potential investment, and what led to the decision to put money into this and energy into building a company?
Yeah, I know I just spoke about Calliope, and I'll go a little bit deeper on that, but, every investment is different, and certainly it's different when you're building a company from scratch, investing in, what is known as the first round of funding, a seed round, or even a Series A financing, which tends to be, a little bit later than a seed and a little bit larger. So, when it's building a company from scratch, it's certainly around, the people and technology. For Calliope, that was based on 3 incredible scientific founders: Charles Zucker, Tom Maniatis, Richard Axel, Nobel Prize winners, Lasker Award winners, all 3 based here at Columbia University. And they had a big idea on deploying technology to map the gut-brain axis. So, in that sense, it was, the risks were, could we build a team here in New York? Could we raise the financing? Would the technology work? We always take technology risk with what we do, right? It's about minimizing that and the other areas, of risk that we see. So, we felt like we had a quote unquote monopoly around, a really good idea and somewhat, ball control when you're um, when you're building it from scratch. Now, with other companies, when you're assessing them a little bit later, you still have some of those same thought processes. Is this the right team and management and the leadership? How differentiated is the technology? Can they build a barrier and a moat? Is this an N of 1 or 2 or 3 company, not an N of 30 or 40? We really do look for differentiated businesses, and often that differentiation and competitive advantage is based on the technology. So that's a little bit of, and then size of outcome for us. Where our early stage fund is a $700 million fund. Our LPs, our limited partners that give us the money to invest, expect a return on their money, obviously, and so if we spend 3 or 4 or 5 years building businesses and then either take that company public or sell that company as a means of an exit, and it only returns 10% of the fund, then it's less about the return and the investment. It's more about the time that we don't get back to invest in other higher yielding return on investment. So it's a roundabout way of saying we're seeking multi-billion, if not decabillion businesses, 10 billion plus, where you can really return the fund with your investment. So you're looking for that outsized return, and so the markets need to be quite large.
You've mentioned people a number of times. We're seeing more and more scientific founders raising large amounts of capital. They may be terrific scientists, but they may not have experience or talent as managers. How much of a role does management versus technology play in your decision making? And given that you're investing at such an early stage, is it just something that you look to change as the company grows?
Well, I will say that, like, most academics that I've worked with or have witnessed in sort of other fundings from other firms, most of those academics are fine being scientific founders, right, and deferring to others to be management. And often those academic founders that I work with help recruit those those operators or management, and they come from their network. Some of those academics like to take board seats if they can, or be on the SAB. I think it's a hard shift from becoming an academic professor to running a company. I've seen it done well. I've seen it done poorly, right? It's a challenge. I'm not saying we wouldn't invest behind those people. In fact, we have. But most academic founders that I see, tend to take a portfolio approach. They want to start a number of companies. You can think of the folks like Bob Langer out of MIT, and Feng Zhang, and George Church at Harvard, and even Charles Zucker, who we've backed a number of times. So we've built 3 companies around Charles. So one of the things that are changing, which you're 100% right on, is academic founders are and have been for some time now the rock stars of life sciences, and that's better and better for them. They're probably getting more equity in these companies and taking more of a role, and that only helps with the success of the company.
You mentioned LPs a moment ago. At the end of the day, you've got to deliver returns to them. How do you think about exits? One of the challenges about making bets on emerging technologies is you can be absolutely right about the potential of a technology, but underestimate the time it'll take to make it commercially viable or successful. In the interim, we've seen multi-billion-dollar valuations long before there are commercial products. So how do you think about your exit opportunities, and when is the time right?
Well, the timing question is, you will definitely get 100 different questions if you ask 100 different people. But look, when you talk about biotech, specifically in terms of exits, you're thinking about IPO and taking a company public, or M&A, which is usually when big pharma with, which tend to have, large cash balances on their balance sheet, they look for emerging biotech to really be the innovation engine for them, and then they will be the commercial engine, right? Not only the commercial engine, but obviously coming earlier and earlier and looking at helping out on development, right? Running the clinical trials and even going earlier and getting a window into what the technology is developing preclinical. So they're the two paths. I think what we look to invest in. We're not looking. We're not looking to flip companies in a short period of time. And I think the best, our best investments is when, we've built solid foundations around, as I said before, team and technology in a sector that we think is quite differentiated and quite, has a ton of innovation. And then those potential exits at the right time will come. The biotech window, most people would tell you today, or, IPO window is quite soft, right? It's hard to take a company public if you're a biotech company, and the returns haven't been quite good. And so if you want to stay, private longer, you need to seek capital in different areas. M&A, I expect to probably, pick up in terms of its frequency in the coming months, given that window isn't open. So they're mainly the two windows, exit sort of scenarios you look for in a biotech company.
We've been in a period where there have been huge amounts of venture capital available for biotech specifically. How much competition is there for good deals? And do you feel you have to make a case for Lux being able to bring more than money to a deal? And if so, what's the value add?
100%. I mean, there is a ton of competition. I think, as I mentioned earlier on in our discussion, we're at the very earliest innings of what I think is, scaling biology and kind of machine and data driven kind of technologies that will improve drug discovery. That question could probably be a discussion for a whole other podcast. There's life science, traditional life science, biotech funds, there's generalist funds, growth funds, and now there's a ton of individuals that are wanting to, invest in matter that matters, right? Invest in, they've seen things like Moderna that have, literally changed, the planet and the world. And that was a company that was founded, 10 years or so ago now, and people want to be involved in that. Look, we've been investing at Lux in biotech for 20 years, so we have a history here. We're not a quote unquote tourist, investor. We've invested across the last, 6 or 7 funds that we've had in biotech. So even though we're not day in, day out biotech, that's where I spend most of my time and my colleague Zavin does. We've been investing in biotech for 2 decades. I think the other thing that differentiates us is we've built companies from scratch. So we know what it takes to build teams, build technologies, license technologies, raise capital, and set the company up for success. And our entrepreneurs and founders that we've worked with, appreciate that. And then, as I mentioned before, the areas and sectors that we invest in, the platform cross-pollination of multiple technologies. Our other portfolio companies aren't off on an island. And so it's really powerful when, these other companies that we've invested in and we're on the boards of, be it, data architecture companies, machine learning, AI companies, robotics companies, automation companies, when you can combine our biotech, companies, our, CEOs and CTOs and CSOs, with the equivalent in those other companies, like 1 + 1 doesn't equal 2. It really does set them apart and accelerate their timeline. So I think that really does differentiate us in the life sciences investing space.
At the same time, there's been a staggering sell-off in biotech. There have been a number of companies that have gone public in recent years that I think 5 years ago would have had to have relied on venture capital for funding. But today, we're seeing preclinical companies go public. How has that affected valuations?
Well, valuations, I mean, stating the obvious on the public side, are a lot softer, right? Like but I think what's positive for those companies that are public, they've raised capital right now, and they have to prove out with that capital. So I would be, if I was on the board of those companies, I would be saying, let's make sure we get to the next value, milestone if we need to raise more capital, or make sure that we get to the right moment in time with the capital that we have. I don't think the valuations on the private side have changed that much, but private always tends to lag public investing, right? Like if you're not getting that potential exit on the IPO public side, then you need to start thinking about those valuations. There's still a ton of, I'm sure you've seen that there were a number of new funds and raised, be it emerging managers, new managers, or existing managers. There's still a ton of capital in the market, and so I think there'll be a real competition and heat for high quality companies and teams, and then on the other side, it might be quite challenging to raise capital at the valuations that were previously seen. But that's only just starting to happen right now.
Looking out during the next year, are you expecting to see down rounds?
It's certainly been a while. As I mentioned, I think the winners will only get stronger, and those that are struggling may need to think creatively about how and when and from who they raise capital. Maybe they do it sooner at less of a valuation increase, and then make sure they have the firepower to see out what is a fairly volatile moment in time. But yeah, maybe. I mean, that's still a TBD for me. I think there's enough capital out there that the real kind of impressive teams and assets and technologies and companies will continue to do well.
Adam Goulburn, partner at Lux Capital. Adam, thanks so much for your time today.
Appreciate it. Thank you.
Thanks for listening. The Bio Report is a production of the Levine Media Group. To automatically download this podcast each week, subscribe to our RSS feed or through iTunes or other podcast manager. To join our mailing list, go to levinemediagroup.com. We'd love to hear from you. If you want to drop us a line or are interested in sponsoring this podcast, send an email to danny@levinemediagroup.com. Special thanks to Jonah Levine, who composed our theme music, and the Jonah Levine Collective, which performs it.